Commodities have been outperforming this year. The S&P Commodity Sector Index up 47% year to date. So can we expect this hot streak to continue or cool down? Meanwhile, there is a cold chill over the crypto markets. Bitcoin down around 35% since January. Ethereum falling over 50% year to date. So how deep into a crypto winter are we, and when can we see signs of spring? Who better to ask than Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Mike, good to have you with us.
Well, hello, Michelle. Thanks for having me, particularly on a Friday afternoon.
All right, let's start with crypto and an overview. We've had layoffs across the crypto sector, Gemini being the last, recently announcing that it's letting go of 10% of the workforce. Cameron and Tyler Winklevoss saying in a blog post that the industry is in a contraction phase known as crypto winter. And that's been consistent with what they call the punctuated equilibrium path of Bitcoin, periods of equilibrium that have seen moments of hypergrowth, followed by sharp contractions and then settling down to a new equilibrium that is higher than the one before. Now that's consistent with what you wrote in your June Cryptos Outlook, and you said what goes up the most faces the greatest mean reversion. So what is the mean value in this case for Bitcoin? What is the new point of equilibrium? What is likely the bottom of this crypto winter phase?
Well, that's the key question. And what you pointed out is specific to the crypto. The more significant, I think, is it's the macro ebbing tide. We're hearing about wage freezes and cuts at firms like Tesla. We're hearing that firms like Walmart and Target and Amazon missing. It's just the beginning, I think, of this hurricane that Jamie Dimon mentioned. The question is, we don't know how bad it's going to get. So I think we're in the midst of the Great Reversion starting of 2022. So it's actually the pendulum just swung back from the, last year, this time we're talking about things like Dogecoin and Shiba Inu, and they just got a little bit too speculative, excessive. And now we're going the other way. And the key fact for everybody, I think, to understand in this whole space is, despite the fact that we've had basically a 30% correction in the NASDAQ, Fed funds tightening and jawboning for the Federal Reserve is actually increasing. That, to me, is the headwind. That's the Fed taking away the punch bowl. And cryptos are just a big part of it. Like you mentioned earlier, they went up the most. Now they're going down the most. And the key thing that's really unique this year that I hadn't predicted early on that's happening is this big spike in energy prices. It's almost a replay of 2008, which energy spiked, accelerated that process of the world going to a recession, mostly U.S.-centric then, and then energy collapsed. And that's what I expect to happen at some point this year, which will be, see if that works out.
All right, but let's focus on the crypto winter phase, particularly Bitcoin, because there are certain calls that 24,000 could be the bottom here. When you do your mean reversion calculation, what is the number that you think would symbolize that?
Well, that's a very dicey calculation. So here's the significance of Bitcoin just returned to its 100-week mean, and the S&P 500 just returned to its 100-week mean at the end of May for the first time in about 2 years. Now, they were overdue. The question is, who comes out ahead? So right now, Bitcoin's hovering around 30,000. It's starting to break below that support. But what's also just broke key support is becoming resistant is the NASDAQ's going down, too. So they're all related. So right now, I fully expect Bitcoin to trade lower. I don't know how much lower, particularly because the tide's going up, the stock market's going up. But what I fully expect is when we see the foundation form, which is going to happen, it's just a question of when and where, Bitcoin and Ethereum should come out ahead. And that's not profound at all because they've been outperforming for so long. I think they have the much better supply-demand adoption case. And what I see happening is there's essentially I see institutional bids below in the cryptos, mostly Bitcoin, and offers above in the stock market.
All right. So when you say outperform, that Bitcoin and Ethereum are going to outperform what exactly?
Well, most risk assets. So Bitcoin's outperformed most equity indices. It's outperformed virtually. Cryptos have outperformed virtually every other asset, depending over what time period. But particularly Bitcoin, most notably the stock market, most notably NASDAQ. It's actually about the same price on a performance basis as it was since 2013 with Tesla, Bitcoin is, but they both represent rapidly advancing technology, really moving in on the incumbent. So this is a process I think going to expect to continue. The thing I've been focusing a little bit on this year is my attention's turned a little bit away from Bitcoin a little bit because what's happening in crude oil. That's to me the most significant macroeconomic development. Fed's tightening, crude oil is rising, it's making the Fed tighten more. But the thing to look forward to, and I'll get back to Bitcoin in a second, I'll explain why, elasticity of supply demand will pressure the price of crude oil. It always has, it always did, and probably always will. We're using less of it and replacing more. That's the big difference with Bitcoin. It's a very small part of most portfolios. It has no elasticity of supply. In fact, the elasticity, the supply by code is going down, and it's just becoming adopted as global digital collateral. So in the short term, I think we're seeing blips in the big picture trends, and that is Bitcoin, most cryptos, with the exception of some of the speculative ones, Ethereum, becoming part of global portfolios and moving into that space. But just like we saw with the internet bubble bursting in 2000, it doesn't come without bumps in the road. When you can measure performance on a 10x, 20x type performance, you got to expect the drawdowns. And this is what we're happening right now. That tide is taking out some of the high flyers the most.
Right. And that's a sentiment that's been echoed by several crypto industry insiders saying, look, there are 19,000 plus cryptocurrencies out there, dozens of blockchain platforms, that this crypto winter is actually a good cleanse or purge. It's good to freeze out some of the excess in a way, similar to your point, how we saw lots of companies collapse in the dot-com bubble, and that the few solid ones remaining will be the ones that really outshine and outperform. You said in your note that we're going to see Bitcoin, Ethereum, and the proliferation of crypto dollars as the lasting trend. So can you break that down for us?
Yeah, so let's start with the last part of that trend. The most widely traded crypto on the planet is Tether. Now, it's somewhat controversial, but Tether is people call it stablecoin. It's a crypto dollar. It's just a token that tracks the dollar. It basically, typically in a typical day trades double the volume of Bitcoin. And the most unique thing that's happening in cryptos is the increasing market capitalization of stablecoins. I call them crypto dollars, so that's what they are. But recently you heard about an algorithmic stablecoin that got hammered. That's just an example of the tide went out. We found out who wasn't wearing clothes.
Luna Terra,
exactly, Terra USD, and we took it out. But that's continuing to proliferate, the increasing market cap of crypto dollars, most notably relative to the other market. That needs to be fine and needs to be pointed out. That's what it's doing to space. Now, what made these things happen? Ethereum, the process of Ethereum, there's basically Ethereum tokens. Now, Ethereum does have competitors, but that's the difference. Ethereum is revolutionizing the world of fintech, of tokenization. To me, the question of what stops tokenization, you look at NFTs. Most of them are based on Ethereum tokens. Now, yes, there's some competitors, but that shows you what's happening in the space, and that's not going away. It's just going to be bumps in the road. And then you have basically the digital version of gold, Bitcoin, in a world that's going digital and decreasing space. So I think what's going to happen initially is we're going to get through this flush period. It's probably going to be significant. We have to get to a period where we see Fed tightening expectations actually turn back down, which is going to take a weakening in the stock market. And then I fully expect Bitcoin is going to be one of the first assets, once it drops to whatever foundation is, to go back to that upward outperformance trajectory. Because what I see is we're going to go back to the pre-COVID trends of deflation. The problem is assets went up so much, they got to come back. And the Fed is making sure that's going to happen.
Okay, and you're not quite able to give me a call on what you think that bottom level is in this crypto winter yet.
Well, I think 30,000 is a very good support pivot in Bitcoin. It basically needs the rest of the market to continue. I mean, basically the equity market to keep going down for it to push it lower. But what I sense is it's bumping into good support, and I fully expect at some point it's going to find it could get to 20. I doubt it does, but I fully expect within the next 2 years it's going to go back to and get to $100,000. It's just a question of time. That's purely by measuring supply by code is going down. Demand and adoption are going up. And the way I look at it, I'll leave you with this statistic, is based on the total market cap of all equities on the planet, which has dropped about 20 trillion to about 100 trillion now. Cryptos are about 1% of that. Now, a few years ago, they were 0.01% of that. A few years before that, they were even less. That process of cryptos becoming a greater part of global portfolios will continue, I think. after we get through this period, the question, and that's the key question, how long does this flush take? And as you mentioned, cleansing, I think we're in early days of cleansing. The key fact is the Fed's still jawboning, stock market just started, and it's way overdue for a good 1/3 correction in the entire stock market. And the S&P had 20%, but it hasn't done a third yet.
Well, Mike, you mentioned Bitcoin as digital gold, and that brings me back to the macro conversation that you said. You said the macro factors are partly responsible for this slump in Bitcoin. In the Gemini note, they write that the crypto winter has been further compounded by the current macroeconomic and geopolitical turmoil. But one of the cases for Bitcoin, certainly made by the maximalists and certainly made by those that compare it to gold, is that it's supposed to be a hedge against inflation. It's supposed to be a store of value asset, a safe haven during these times of uncertainty. And we haven't seen it perform like that at all. It's been highly correlated to the NASDAQ. Why has it been acting like a risk-on asset?
Transition period. So it has been one of the most significant risk-on assets ever. I mean, it's the best performing asset in the history of mankind. So it's got to purge some of that risk on. What I see is it's transitioned to a risk-off asset. It might happen this year, and I suspect it will. It depends how, and this is going to take some time. So here's the fact: is overall volatility of Bitcoin, maybe 200, the annualized volatility, has been declining versus the stock market, versus gold, versus crude oil, versus every asset on the planet, most notably for the last 5 or 10 years. That's the process of actually 260-day volatility in Bitcoin is almost the exact same as Tesla is now, the same as Amazon was in 2009, and the same as what gold was in 1980. So what you're seeing, what I'm describing to you is the maturation of a nascent asset / technology. It's getting there. It's just not going to happen overnight. And I'm an impatient person. Most people hold it are. But it's just not going to happen overnight. And let's put ourselves 5-10 years in the future. This asset is a revolution in the ability to be able to store, transact, and transmit value. And that's the key thing I'll leave you with. There is no asset I've ever seen, and no one's ever seen in history of mankind, that's more fluid, more tradable, with price discovery on a 24/7 basis than Bitcoin. And that has value, and it's just starting to pick up. And a good way to show that is, markets are shutting down in a few hours for the weekend. We had a holiday in the U.S. on Monday. Markets were shut. Doesn't happen in Bitcoin. It trades 24/7 all the time. That's the revolution that's happening, that's trickling into other assets.
All right. So you're saying it's just a phase, a growing pains phase for Bitcoin, but you don't see this current situation where it's not responding to inflation and other macroeconomic factors as it should, as hurting the long-term case for Bitcoin. Sounds like you're still pretty bullish on Bitcoin hitting 100,000 in 2025. And that is actually consistent in what you said during a Kitco interview in October 2020, that Bitcoin is on track to hit 100K by 2025. What gets us there? What gets us out of this winter and into spring? What do you think needs to happen to spark a rally?
Well, I think what's going to happen is the Great Reversion is just getting started. It might be like the aftermath of 1929. I think it's going to be like the aftermath of 2008. Maybe like after the 1987 crash. It's so overdue, and all risk assets everywhere, from condos in Miami and Toronto to the stock market. It's just starting to happen, and the greatest inflation in 40 years in most people's lifetime is just starting that. Once we kind of get through that period, I think Bitcoin is going to realize that this is one of the best assets on the planet to hold. Now, that's my base case. Well, how that works out, I don't know. So I see, my outlook is, I think some of the best assets to own will be gold, U.S. long bonds, and Bitcoin. I think we're going back to deflation, and best way to get deflation is get a big spike up in prices and then flush them. And that's what we're doing. We're in early days of flushing. So you just look at the stock market. The fact that it's facing more and more tightening, and it's already down 30%, is something most people who have invested in the last 40 years have not seen. This is the new world. To me, that's where we're going. How that base case changes, I don't know. But I think I'm impatient, but right now, what I see happening in crude oil is playing out just like it did in 2008. It peaked on July 3rd, and then by the end of the year, it was down to $40. Then that was when it went to $145. That sparked massive deflation. I see a similar, I see parallels this year.
Okay, so let's focus on that point, because you say that it's going to have commodities will keep rising and then revert to a mean, like what happened in 2008. But it's a very different scenario in terms of we have the Fed raising rates at the moment. We've got rising inflation. We've got a tight labor market, conditions that didn't quite exist in 2008. We've also got some indications of deglobalization risks, which could have permanent impacts on supply chains. So what takes us to that deflationary environment?
Reversion to what happened to the means and to what was the case before COVID. So it's the key fact is rapidly advancing technology is massively deflationary. We're just getting a blip in that trend. And the key fact most people need to realize is the U.S. money supply just about a year ago jumped up to the highest ever on an annualized basis. That was 26%. Now our measure goes back to 1960. Now it's reverting. That's the number one factor of all inflation. Money supply is going back, everything's coming back, it's going back to normal. And the key thing is what has changed in terms of inflation since before COVID. The key fact is prices went up too high, which means they're going to go back down further. That's not profound. So I'll give you an example of crude oil. Crude oil, the world's most significant commodity, at the beginning of 2020 when it first collapsed, was at the same price as 1999. That's 20 years ago. Now, it's one of the worst performing commodities. Since then, the Bloomberg Commodity Index, if you look back since the beginning of 1999, is up about 500%. Crude oil is about 300%, because it's been arbed away. We can create more of it. We use less of it with technology. Now, yes, right now we have this major war going on, but if you remember the last time we had significant war-related pumps in crude oil, the 1990 Iraq invasion of Kuwait, crude oil went from 20 to 40, it dropped back down to 20, and it took 13 years to take out the high. What's changed? U.S. energy dependent. We are now the world's largest energy producer and a net exporter. That's only because of adopting that technology. So to me, what we're seeing is the Great Reversion, and we have a situation now, the average household in this country is more overweight the stock market than any time in the history of mankind. That means just a little bit of blip. We're seeing it happen slowly, but it's taking it away. We're all going to go back to a world where this great, resignation is going to revert back to probably much higher unemployment. It's just a matter of time. It's just the way it works. But in terms of things I watch, like commodities and assets, they're just in the early days of reverting, and Bitcoin should be one of the ones that come out ahead.
All right. So where does gold fit into this picture?
Just like Bitcoin, the problem is it's what's happening with gold is being replaced by the better technology. So I'm bullish gold. Like everybody else, I'm frustrated. I think what gold needs is one key inflection point. Is I watched that Fed funds, that 1 year curve, and once that 1 year curve is starting to turn back up a little, meaning that we're starting to price in, and the tightening cycle, maybe switching back to easing. Once we get a good sign of that, gold should break out higher. The problem is I look at gold now, is you can't really hold gold anymore without some Bitcoin in that bucket unless you're taking a lot of risk. And these are the risks that Russia has taken and China has taken. They're really pushing back on 21st century technology. So to me, it's a matter of time. But again, the thing is, it's just like what's happening in crude oil, it's being replaced by technology. So is gold, but it's just a matter of time. It should break out and do higher. So I think what's going to happen in gold is once we see a little peak in long bond yields, a little end of all this hiking expectation from the Fed, which is going to come from a lower stock market, gold takes off, bond prices take off, and Bitcoin should join that party.
You mentioned in your report that as global GDP declines, we're going to see demand for commodities taper off, particularly demand for industrial metals like copper will go down. So where does silver fit into this picture, particularly as the move to decarbonize continues with oil where it is? How does silver fit into the bigger picture here?
It's stuck with copper, and I'm glad you brought in silver because I look at silver, it's more of an industrial metal now. It's certainly not used as precious as much. It's really stuck with copper. So copper's down on the year, and that to me is my key indicator. Dr. Copper dropping with crude oil rallying is an indication of copper and silver being poor performance this year are showing us that we have a major economic problem. These are the metals that should perform the best in the next 5, 10, 20 years. I fully expect that. But in the short term, the fact that they're getting hammered versus crude oil going up shows the bigger picture is a recession globally, and then they'll come out ahead as they are the main demand source for decarbonization and electrification. Crude oil isn't, and that to me is part of the fact. So there's a global, we have a Bloomberg Global GDP tracker. It's a good way to track expectations for global GDP. At the beginning of the year, it was running 5%. Most people expected that. Now it's ticking down to near zero. I don't see what's going to stop that, particularly with the Fed tightening, crude oil going higher, and this major sentiment of wars and things like shootings and stuff. We're probably going to see a global recession. That's just what's happening. It's a matter of time.
All right. Final question for you, Mike, from our producer, Cornelius, because he wants to know, if you have $100 million right now, how do you allocate it? How do you divide it between commodities, cryptos, equities with a 2-year holding period?
There's nothing wrong with cash. This TINA narrative, we're going to look back at that from history and realize that, okay, that probably wasn't good to just buy because you have to keep up with inflation. So start with cash, and I fully expect, I can't give investment advice, so I will point out I think the best performing assets will revert to gold, U.S. long bonds, and Bitcoin. I think will perform the best. And I say if there's any time in life, there's certain times to overweight equities. In the last 10 years was a very good period for that. I think we should have a period in the next, who knows how long period, maybe 5 years, maybe 10 years, where underweight equities will be the better way to be.
Mike, we're going to let you go and get your Friday happy hour drink. Thank you so much for joining us here on Kitco. Appreciate it.
Thanks for having me.
Mike McGlone.